Hey everyone, as we enter December, I want to take a moment to consider where we were a year ago. At the beginning of December in 2020, much of the US was still locked down to one degree or another. Air travel was at about 30% of 2019 levels, and the first public COVID vaccination had yet to be administered. Headline inflation was just 1.3%, and the 10-year Treasury was below 1%. Today, we're approaching 60% vaccination rates in the United States. Air travel on the Sunday after Thanksgiving this year was 7.5% higher than it was on that same Sunday in 2019. Headline inflation is now 6.2%, and the 10-year Treasury is around 1.5%. These are big changes economically and big changes for commercial real estate, especially from a sales standpoint. This week, I'm going to focus on the commercial real estate transactional climate and what it means for investors. Through the third quarter of this year, commercial real estate transactions are up by 12.7%, above 2019 levels. Compared to the same period in 2020, they're up 63.5%. According to Real Capital Analytics, self-storage property transactions have surged by 56% compared to 2019, and hospitality deals are up by 46%. Industrial property sales posted a transaction gain of 17.4% from 2019 levels, and apartment sales rose by 15.4%. Even retail real estate transactions were up by 7.9% compared to the first three quarters of 2019. The only property type lagging 2019's transaction level is office, which had 4.6% fewer transactions this year. Notably though, the medical office subsector is up by 12%. Sales velocity has surged so far this year, and the preliminary data for fourth quarter looks promising. Why is transaction activity so strong? Part of it reflects activity that was put on hold in 2020 and pushed into 21. But there are a variety of factors supporting investment in commercial real estate this year. One key factor is that financial liquidity is way up. The US money supply is up by 28% from pre-pandemic levels, and investors are flush with cash. Another factor is elevated inflation. Many types of commercial real estate have built-in inflation resistance, and that is attracting new investors to the market. In times like this, when inflation pressure is elevated, commercial real estate can outperform other investment classes. But all this capital pursuing real estate has pushed up prices aggressively and put downward pressure on cap rates. Nationally, average multifamily cap rates are down 30 basis points from 2019, but cap rates in some markets like Austin, Texas, and Phoenix, Arizona are down more than 70 basis points. Average industrial cap rates are down 35 basis points from 2019, with top-tier assets trading in the 3% range or even lower in some instances. Average retail cap rates are down about 25 basis points, and office cap rates have pushed down about 10 basis points below where they were 2 years ago. In general, commercial real estate prices have appreciated measurably this year, delivering positive results for investors. The pandemic did take a toll on the industry. That was readily apparent last year. And some property types and some metros are still recovering. Urban hotels, older shopping centers, urban office in several cities, some seniors housing properties, and so on. But the overall momentum is positive, and the milestones hit in 2021 have more than offset the weakening of last year in most cases. The last 2 years have been a bit of a roller coaster ride. But commercial real estate is a long-term investment, and despite the pandemic, investors that kept their eyes on the horizon throughout this tumultuous cycle are coming out the other side in a very strong position.